Okay. And we are live. Hello, everyone. Welcome to Milton's Briefs. Welcome to the show. Make sure this is set up all good. Beautiful. Okay. Welcome to today's episode. It is November 6th, 2025. And today we're covering a multitude of news today. A lot of stuff happening in the market, including, but not limited to, a report from Challenger Gray that this month was the worst since 20 years. In over 20 years, the layoff report was the worst this month. So this is a really bombshell report that's coming out, especially considering that yesterday was a somewhat optimistic jobs report from ADP, and now the pendulum swings completely the opposite direction. So we're going to cover that. And the next one we're going to cover is Cleveland Fed President Beth Hammack stating that cutting interest rates is not so obvious and may not be the right call in the market, especially with how the economy is with inflation. So we're going to cover that. Then we're going to cover OpenAI CEO Sam Altman denying that his company is looking for or seeking any government bailout, which is really fascinating to see because the amount of research and energy and financials that you need to support data centers is an incredible cost. It is a lot of money. It takes a lot of power and electricity, and we're going to cover all those costs coming up. And then also I didn't write this down, but the government shutdown, again, is the longest government shutdown in U.S. history. And there's going to be very detrimental consequences that will be coming from that just came out today. So if all this information is making you curious to learn more, please like, share, subscribe to the channel, comment your thoughts below, and we're going to get right into the first headline that I mentioned. So from CNBC article here, job cuts in October hit the highest level for the month in 22 years. Challenger says. And this is why I wouldn't be surprised if that somewhat optimistic jobs report from ADP gets revised down because of this report that came out here. So let's understand why that's happening. So again, this report is not a government report. Many government reports are very delayed or may not even be happening at all due to the government shutdown. So it's very important to keep that in mind. So let's see here. So job cuts for October totaling 153,000 jobs is a 183% surge from September and a 175% higher rate in the same month than a year prior. So that means that basically from October in 2024 till now is a 175% jump from this month a year ago, which is incredible, like unbelievable jump. So this has been the highest level for any October since 2003, and basically when I was 2 or 3 years old, pretty much. And it's been the worst year for layoffs since 2009, which for many of you who remember most recent history, 2008 was the great financial crisis of 2008. So again, these layoffs hitting those similar numbers back in 2009 is a very, very strong warning sign of bad things to come. Companies in the technology sector announced over 33,000 job cuts, nearly 6 times the level in September. So again, very concerning here. So like in 2003, a disruptive technology is changing the landscape. And this is true. What we're seeing with artificial intelligence being implemented in the workplace and how many companies are headlining this, especially with technology firms such as Meta and Apple and Google, Amazon, and many, many more. So it's definitely something to pay attention to. The report provides a glimpse into the labor market at a time when the government has suspended data gathering and releases, as I stated, due to the shutdown in Washington, D.C. To be sure, the Challenger monthly numbers can be highly volatile. They can be highly volatile, and an accelerated pace of layoffs has yet to show up in state-level weekly jobless claim filings that continue to come in despite the shutdown. So this is a really important point here because we're only getting a sort of very soft landing analysis of what the job market is ongoing right now. What's going on with the job market. And this is some data, but there's so much more data that financial experts, investors, politicians even can be analyzing, and Americans. So there's so much more information that we don't know, which can be a scary thought. that we're seeing these numbers based off limited data. So payrolls processing firm ADP reported that October saw a net job growth, as I stated earlier in yesterday's stream, a net growth of 42,000 jobs. But however, the report comes at a time when the Federal Reserve officials have expressed concern about a softening labor market. And just as we've seen from the report in the ADP report, July was the last month that we saw a net growth in job creation, which is a very strong concern, considering that the tariff policies from President Trump were really started to kick off back in the summer of 2025. So all these things are really key points to keep in mind here, because the President Trump is going to get his wish with cutting interest rates right now. He's going to complain that it's too late, but they're occurring right now in the fall, in the Q3, Q4 term of 2025. So it's going to be very interesting to pay attention to how that's going to affect the inflation rate in the United States, especially considering that these tariffs are having an upward pressure on many consumer goods that Americans buy every single day, such as groceries, furniture, kitchen supplies, toys even. So considering the Black Friday, November shopping spree, and December with Christmas time and lots of holidays where families get together, it's very important to keep in mind how much are Americans going to pull back, considering that inflation is steadily creeping up. And this is based off limited data. We don't know all of the complete data. Just for the CPI report from September, I believe. So a couple months back. So let's get into a video analysis from Bloomberg podcasts of U.S. companies announcing this jobs cut, the biggest jobs cut in 20 years. And let's see what they say here. This gentleman right here is, I'll just play the video because I don't remember who this gentleman is, but I believe he's a financial professional.
There's kind of this internal turmoil right now in terms of the environment. Is it inflation we have to worry about? We saw that companies announced the most job cuts for any October in more than 2 decades. This from Challenger Gray and Christmas, and they did talk about an AI component to it. I can't figure out where we are. What do you think? Where are we?
It's like the flavor changes almost literally every day, because this morning, I mean, it was much more labor driven. You had the Challenger data you mentioned, but you also had data from Revelio Labs, which has become, much more important to look at in terms of private sector providers and what they're looking at for job growth. And what they showed for October was a decline of 9,000 for payrolls. But, for me, the labor market stuff is almost this hall of mirrors, because all of the different indicators tell you completely different things as to what's going on in the labor market. If you look at claims data, which we're not getting at the national level, but if you aggregate everything at the state level, it still looks relatively healthy. It's stayed relatively low and stable. If you look at ADP for October, surprise to the upside, as we learned, a couple of days ago. If you look at something like Revelio, though, weak. If you look at something like Challenger, also weak. The interesting thing with Challenger is, and we always try to make this, important distinction in.
And Challenger is the name of the company or the firm that published this report of the jobs cuts, just to clear that up.
Emphasis for investors, they're layoff announcements. They're not exactly cuts themselves. So there is a little bit of a lag there in terms of what you can expect.
Yeah, oftentimes 90 days.
Right. Plus, I think the one thing that is, I will say, maybe a little bit more worrisome with the one for October relative to what we saw earlier this year, because there was a huge pickup in Challenger job cut announcements earlier this year, but most of that was at the federal level. That was focused on what everything was going on regarding DOGE.
Like DOGE,
This one's a little bit more broad-based. As you mentioned with the AI overlay, the concentration for the sectors was mostly in tech and warehousing, so clearly
there's cost-cutting going on by companies, which is never a good feeling.
No, and I think what's been interesting so far, it's been relatively methodical, where it's gone sector by sector. It hasn't been broad-based across the economy, which I know I've talked about this with you guys a lot, and Lizanne, who I work with closely on this, are the sort of this concept and thesis of rolling recessions in the economy. You're still experiencing that to some extent, where it's not filtering up to the surface, and it's not aggregating together to give you a full-blown traditional recession, but it's still happening in pockets.
We know her as Lizanne. We all call her Lizanne Saunders, too. Exactly. That's the Lizanne you're referring to.
Well, and she's their chief global strategist.
So first of all, I like this quote in the bottom of this headline right here that Schwab's Gordon says, quote, "There is no alternative to government data." And this is what I was saying the whole time in yesterday's stream and today as well, is that there's not a comprehensive report of the job market right now. We have to rely on these very small I don't want to say small sample sizes because he said this was a more broad report, but the Federal Reserve Board and many Americans and investors have to take a huge leap of faith in analyzing this data in how the market's going to go. And it's not as comprehensive as the government reports. So it's a very strange time in American history, considering that really the stock market hasn't had this long amount of time, over a month now, at 37th day, I think we're of the shutdown, approximately. We haven't had this long of a shutdown before in history. And investors are, a lot of people are kind of in the blind here as far as what's going on in the economy. And if it weren't for these firms publishing these reports, nobody would really know.
That's right, our investment strategist. Yeah, the big part. And you guys are
my first boss, my mentor.
And she loves you.
Oh,
we had her on our program yesterday.
She's the best.
So, Kevin, going from the corporate world and thinking about, okay, what are companies doing with employees? How are they hiring? How are they firing? How are they announcing this? To consumer spending, because the consumer powers this economy.
Yeah.
We're getting some troubling anecdotes. What do you see?
You know what's interesting is that when you look at, I mean, this is where the labor market's so crucial to understand the differences between the stock and the flow. So the stock of labor is still relatively healthy. I mean, you look at a mostly fully employed America, and that's where we're at. Any of the layoff activity we've seen is just at the margin relatively minimal. So if you see relatively low layoffs, despite a very low hiring rate, which we're basically at cycle lows, the fact that the stock of labor is strong means that the aggregate income growth month to month, assuming you stay employed, is relatively strong. So that's why real spending is still positive. But to your point about some of these anecdotes and some of these cracks under the surface, they are starting to widen a little bit more, especially if you look at that bottom half of the what everybody calls now the K-shaped sort of economy.
How do economists look at that bottom rung?
You could break it down by wealth level. I like the Fed data and looking at sort of percentile levels of wealth.
But in terms of like overall economic growth and what the Fed, like how do you think about?
This is the tough part because, you know, when you
there's
look
a social answer and then there's like.
Well, the multiplier effect up the wealth and the income spectrum is just much stronger.
Yeah.
That's just the math. And when you look at how well asset markets have done over the past couple of years, even this year, the bounce.
It's interesting that he says this too, and I think this has been true for wealthy people in a lot of ways, is that the wealthier you are, the more wealth you're going to gain, because the stock market, for anybody that's even paying remote attention to it remotely, you're going to see that the S&P 500 has hit records every single month of the year so far, despite the announcement of the quote-unquote Liberation Day that President Trump announced, with the stocks tanking back then, many 401ks hitting rock bottom, some people even cashing out the 401ks at that moment, which was going viral on TikTok and on these social media platforms. And so despite all that chaos in the stock market, we saw it a rise. And now the stock market hitting records due to AI and technology stocks really getting on a tear. And these stocks include like the Robinhood, that has had over 100% gain, I think, year to date. Palantir was a really big up-and-coming financial technology stock that has overtaken artificial intelligence with having deals with the United States government, having deals with Israel, with Saudi Arabia, and probably many other countries or institutions that I'm not aware of off the top of my head. So there's just a lot more information and a lot more wealth growth that you can see in these stocks and being able to invest large sums of it. And it's why that we've seen people like Warren Buffett announce like tons of money in investment in the United Healthcare stock when it was tanking early in the year. So they have the freedom to be able to do this because they have a lot of capital. But for many Americans that don't have a lot of capital, that aren't investing in the stock market and aren't investing in this opportunity, like you see here, where high-income Americans are behind half of U.S. consumer spending, that's a huge statistic right there, because that shows that Americans are pulling back on spending. And if they are spending, it's on necessities and not on more so expensive luxuries.
From the April lows. I mean, if you're benefiting from that as an asset owner, we have household exposure to equities at an all-time high, beyond where we were, just slightly, but still beyond where we were at the peak in 2000. So the wealth effect and the power of the market in terms of an economic driver has become quite strong and quite potent. So I think when you add that together with what is traditionally an economy that has become more, or I shouldn't say traditionally, but over time has become more powered by that wealthy cohort, then you've got a pretty strong effect.
When you say full employment, how do you define that, and then how does the Fed define that?
Okay, so we'll go into the next topic now. That kind of got a good summary of what's going on with the jobs cuts, that the biggest jobs cut in 20 years, in over 20 years. Again, a really huge report here, really big, because this is something that we don't see often at all. Let's see, there's some more analysis on this from another professional from Bloomberg here.
We've been waiting to see whether there would be a lot of layoffs coming because the economy is slowed because of the tariffs, because of other economic policies. And we may be starting to see that turning point. It's been slower than anticipated. The question is, how many of these are actually in the United States and how many of them are going to be carried out in the near future? The Challenger numbers came out today. The biggest jump since 2003, biggest number of layoffs announced in October. But that, again, it's just announcements. So we have to wait and see how this plays out. And when you look at some of the companies like Amazon, with all the layoffs they announced, they still gave people 90 days notice. So you won't see this show up in any data.
That's a really great point, that in a way, this layoff report could be a lot higher than what they're actually letting on, because of these announcements that are pending layoffs. That could be for potentially December or January. And as you can see here in this graph, 81,000 job cuts in 2020, and that was the height of the pandemic that occurred. Many people were losing their jobs. So the fact that at this year we are at a rate of almost double the rate of layoffs in 2020 is a very concerning sign that more people should be paying attention to.
For a couple of months.
Okay, so I think Jay Powell and others had characterized this labor market as a low hire, low fire. Is it morphing into something different, like a low hire, a pickup in fire?
Well, that's what the Fed wants to know, and we don't have good ways of tracking that, other than maybe the initial jobless claims. Each state puts them out, so we get them at 4:30 p.m. today, and we will adjust them for seasonals and things like that, and have a pretty good idea of roughly where.
Wait, this is separate from the weekly jobless claims that comes out by the government.
This is the data that goes into the weekly jobless claims, but the Labor Department is not tallying it now and not adjusting it. We do that ourselves. We can't call DoorDash to come do that for us. So we do that, and we'll have a pretty good idea of what the numbers are. And last week was 218,000, so it was nothing. So if there is a turning point, it's not showing up in the data yet. Now, you might see a change in unemployment, except that there's no unemployment report on Friday. So,
all right. Well, the good friend.
Okay, so just some more information there on this. This is really interesting. This is why I encourage everybody to share this with their friends and family, because it's a really big report that's happening here. So again, so we covered that report that occurred. Job cuts are happening, the highest rate in over 20 years. Last time this occurred is 2003, at the height of technology taking over the stock market, and we're seeing that right now. And in response to that, so major sell-off today. I think the S&P dropped over 1%. So a major sell-off in that, and the NASDAQ dropped as well. So in response to that, what happened? So bonds rallied, and we're going to explain this here. I don't know if this has all the data on the bonds. I may have to look at another article. Okay, it does. Great. So I'll zoom in here for you all. Okay, so the S&P fell about 1%, like I stated. NASDAQ dropped a little bit more, 1.5%, because there's a lot more technology stocks in the NASDAQ. So what happened? So let's see. So due to this worrisome report, the yields are going to go down. Why is that? Because when more people purchase bonds in the stock market, or bonds, when more people purchase bonds, treasury bonds, that is going to lower the yield on the bond. So for bonds, for those who don't know, it's an inverse relationship. So when there's higher demand for bonds, then the yields are going to fall. And when there's a lower demand for bonds, the yields are going to go up. Now, you may ask yourself, what does this mean? Because I don't know what the word yield means. And again, there's nothing wrong with that. So the yield is the interest. So say that if you are you're considering buying a bond, but a lot of people don't want to get bonds and there's low demand. So what's going to happen is the government is going to try to entice you to get the bond by by increasing the yield or the interest paid out to you. So if you purchase this bond at this price, they're going to pay you out more interest on that bond if you buy the bond. And likewise, inversely, if the bond is more expensive due to high demand, a lot of Americans are trying to, or other investors are trying to get into the bond market, trying to invest in bonds, the interest rate on those bonds is going to be less, or interest, the yield is going to be dropping and less because so many bonds are being sold or bought, and so there's not as much of pressure on the government to increase the interest to pay out to investors. So that's kind of what the bond market is in a very concise nutshell for you all to understand. So we can get into the numbers right here. So the yield on the 10-year Treasury slid 7 basis points to 4.09%, and the dollar fell 0.1%, not too much. Bitcoin lost 1.5%. Okay, so let's see if there's any more. Not a huge fan of this website, to be honest. So let's get into some of the data that occurred. So we can see it's a little bit lagging here. So bonds rally. I don't need like the data for every single point here. So we're just going to look at the rally that occurred. Okay, I'm not finding it right now. I may look into it later, but let's move on to another topic here. So as I said earlier, the bonds rallied, and what that means is when bonds rally, that means that there's a higher demand for bonds. So investors are seeing, oh, this is really bad news. There's lots of job cuts that are happening in the United States. I need to protect my assets, protect my income, so I want to invest more in bonds. That's sort of the nutshell of what that means. So let's transition to the next article here, the next topic. And like I said earlier at the beginning of the show, the Fed chair, the Cleveland branch Federal Reserve chairwoman here, President Hammack, says she would prefer to have rates on a more restrictive side of neutral. Now, she made it very clear she's not in favor of increasing interest rates, but she's hesitant on supporting cutting interest rates. And let's see why that is. So the Federal Reserve Bank of Cleveland President Beth Hammack reaffirmed her hawkish position on monetary policy today, stating that while she doesn't currently support raising interest rates, she believes the Fed should maintain a restrictive policy stance to address persistent inflation. And it's interesting because to me, this seems like common sense when we're seeing inflation rise so much. But this is where the politics come into play, where you have to choose who you want to value. Do you want to value the jobs market and cutting interest rates so that borrowing is more easy to spur up the jobs market, or are you going to be concerned with inflation? Because sadly, it's really difficult to cater to those two objectives. And the Federal Reserve has a very difficult responsibility in doing so, because before the tariffs were announced back in April, or before they even really started this year, inflation was coming down, and now we're seeing a reversal of that, and the job market is seeing a decline. So the Federal Reserve is in a really interesting position right now. So yeah, it's really interesting. And this is what Hammack says right here. She says, quote, "Her inflation remains too high." She clarified that raising interest rates is not my base case right now. However, she outlined specific conditions that could shift her perspective. So again, Hammack doesn't hold any voting position in the FOMC. And for those of you who don't know, the Federal Open Market Committee is the committee that meets almost every month to decide whether to raise rates, cut rates, or keep interest rates steady. And they review the data together and all of that. So she's not part of that committee. However, just like anybody that's in a position of authority when it comes to the Federal Reserve or anything like that, outside of the actual chair or committee, excuse me, they're going to hold a lot of water. They're going to hold a lot of say, just like the president does in the bully pulpit. So I think it's really interesting to hear what people have to say, professionals have to say about this. And here we go. Regarding the labor market, Hammack characterized the current environment as low hiring, low firing based on the feedback from business contacts. While acknowledging hiring challenges, she said she doesn't assign high odds on the labor market downturn at this time. So right here, you can see that Hammack is prioritizing keeping inflation at a lower rate and stating that the job market isn't at a critical place where we need to be cutting interest rates. That is her point of view. So again, the financial markets will continue to expect another Fed rate cut in December. I know the odds right now are about 60% chance of a federal rate cut. And in the most recent meeting that Jerome Powell spoke at, who's the Federal Reserve chairperson right now, he stated that there is no guarantee of whether the cut will happen or not, which I think makes sense because again, there's not a lot of data and information for the Federal Reserve to go off of, and Jerome Powell is really well known to not share his cards. And anybody that pays any attention to his press meetings, he's very hesitant to reveal his cards. He always says he wanted to review the data first and then move forward. So that's no surprise at all. So I just want to include that because I think it's really interesting to hear another perspective outside of the FOMC committee. So let's go into the next topic that I mentioned today, which is OpenAI. I'll read what I said here. So OpenAI CEO Sam Altman denies that his company is looking for a government bailout. So that's the story. And the headline for CNN here is why OpenAI went to crisis PR mode on Thursday. Now you may be wondering why I mentioned Sam Altman, and there's a picture of a woman right here and not Sam Altman. Well, this is because this is Sam Fryer, who is OpenAI's CFO, and she made a very controversial statement about a potential wanting a government bailout and the theories around that. And we're going to get into that right now because this is really fascinating considering this. So the reasoning for this is there's concern that they don't have all the funding for data centers. And I mentioned this in the beginning of the episode here. And let's try to understand why that is. Because you would imagine that if you spend a lot of money, invest in certain products, you have the capital for it. But it doesn't seem like they do, or potentially may not. So two top executives ferociously backtracked from an earlier comment that suggested that OpenAI might need government support to cover the $1.4 trillion in chips and data center infrastructure it's committed to buying. So here's how it unfolded. This is really interesting. So this is where the whole controversy started and why it seems like they were really looking for this bailout, which is kind of crazy considering that so many companies got bailouts back in the 2008 financial crisis. It's very eye-opening to see what's going on here. So OpenAI's chief financial officer, or CFO, Sarah Fryer, raised eyebrows on Wednesday when she suggested the U.S. government should backstop the company's aggressive investments in artificial or AI infrastructure. And you may wonder what that means. I'm glad you're thinking that because I was wondering the same thing. So that basically means a federal government backstop for the debt AI companies could take on to make chip investments. So in other words, the government can sort of support in funding for this project. So Fryer quickly walked back to her comments, clarifying that the government needs to play their part in combination with the private sector to contribute to America's AI growth, which again, to me, that's even worse trying to backtrack because you're basically saying the quiet part out loud, and that the government needing to do their part is basically, hey, come back me up with this funding. I mean, that's what it seems like to me. But OpenAI was not seeking a government backstop for our infrastructure commitments. So that's what Sam Altman said. So this is a pretty big deal because it's a lot of money, especially because OpenAI is valued at $500 billion. And this project you'll need double that money for this project of $1 trillion for data centers. It takes a lot of electricity to run these data centers. And it's not surprising that this happened here. So obviously Altman reiterated this, but let's get a financial analysis perspective here on this because there's so much information on this, and I want to get kind of narrowed down from a professional's point of view, professional analyst, like what's really happening here? AI. It's the second search engine, so people were definitely looking it up. Okay, so I know this person has a really good analysis of a lot of things here. So let's see if he has.
This is a screenshot, literally a screenshot from our.
Actually, let me try to find someone else. This is a little bit. Looks like there's not many videos on this, so I may have to just do that video potentially. Okay, here we go. So here's a CNBC article. So Trump AI czar, quote unquote, David Sachs, who's a pretty wealthy investor, states that there is no federal bailout for AI, and that's when some of the, I think Nvidia or some stocks tanked after hearing that. But let's see why that is.
With a news alert, Mac.
Hey, Frank. So White House AI and crypto czar David Sachs is pushing back hard on the idea of a federal bailout for America's leading AI firms. He just posted on X that the U.S. has at least 5 major frontier model companies and that if one of them fails, others will take its place. It all appears to be a not-so-subtle shot at OpenAI CFO Sarah Friar, who on Wednesday suggested the U.S. government could help guarantee financing for AI data centers, a move that would lower borrowing costs for companies racing to build massive compute infrastructure. Friar, she has since walked back those comments. In Sachs, he did say the government should focus on speeding up permitting and power generation, but he emphasized it would be ridiculous to give an AI company a bailout. Frank?
Okay, Zagalos, thank you very much. And just by the way, OpenAI CFO will be right here on CNBC tomorrow at 10 a.m. Eastern, speaking with our Sarah.
Okay, that wasn't really a breakdown at all, but I'm really curious to see what script that she's going to have tomorrow to kind of cover her tracks on this, because this is definitely interesting. Yeah, very interesting. Yes, it looks like there's not much information on it beside that article, so I can't comment too much on it. But yeah, it's just fascinating to me seeing how the government, like so many companies are after these government subsidies. I mean, we saw what Elon Musk was after with President Trump, endorsing him, giving him tons of money for his campaigning with him, not only just being a huge donor for President Trump, but actually campaigning with him, having a place in his government department, creating the Department of Government Efficiency, excuse me, and doing all that. And then he didn't even get what he wanted, was government subsidies for Tesla vehicles, really, for those cars that he wanted. That was his whole objective with campaigning for Trump and all that. And it's just fascinating because so many people are against handouts here and there, but so many people don't talk about these subsidies, or in other words, handouts that these really big conglomerate companies get from these tax bills. Really big tax breaks. So many people don't talk about that. They don't cover that at all. So just something I thought about there. But let's go into this Bloomberg article and talk about the U.S. government shutdown. So again, like I said earlier, it's the longest shutdown in government history, in America's whole history since its founding. And we're going to talk about what else is going on, what other consequences that are going to happen. So like I said before, the United States government shut down. Ever since November 1st, SNAP benefits are not going to be funded for millions of Americans across the country. I believe that's about 40 million or 41 million Americans that are on SNAP. So they're in danger of not having their SNAP cards funded. So that's a really big part of the government that is not going to be funded. Again, politicians are funded. So all those politicians and senators during a government shutdown are funded, despite not having an agreement or negotiating a deal at all, which is kind of surprising, but that kind of explains the popularity of the Congress for you right there. And then another point is, let me think, what else? Government workers like air traffic controllers, many of them are forced to work without pay. And this has been over a month now that they haven't been paid in a very high stress job. And so we're going to go into what the consequences are of that, because it's just really important to talk about here. So let's get into this video here.
disruption of this magnitude mean for air traffic control?
So this would So this would actually be a really bad step for the airline industry because they're going to have to reduce flights in order to actually make these cuts. And so we're going to see a situation where airlines are forced to have to cut their flights, cut routes, and cut services to destinations, which could lead to some disruption for passengers who book travel, especially as we go into the holidays. And we have to see how long this shutdown lasts. And then the FAA did say that this could scale up or scale down depending on how it goes. And so we could see a situation where this is only the start of in terms of the impact on the air traffic control. This could just be the start of it, and airlines could be forced to cut even more capacity.
Wow, 8. So U.S. may cut air traffic by 10% by Friday if no shutdown deal occurs. So it's by 10%. Man, that's unbelievable.
And that would be disruptive, especially as they go into the holiday period.
Yeah, the timing here is pretty difficult with just weeks until the Thanksgiving travel season. And I guess the idea here is to try to leverage this move to end the shutdown before we get there. But put this in perspective. How many flights would represent a 10% cut? Is that hundreds or thousands?
It's thousands of flights. Yeah. I mean, the U.S. sees thousands of flights a day, and this would be a massive impact. And also, I mean, the ATC controllers haven't been paid since October 1st, and that's sort of having an impact. I mean, Duffy talked about how the first paycheck is something that the FAA controllers can get through, but when they go to the next stage, the second paycheck is where it starts to hurt. And that's where air traffic controllers are sort of not coming into work, and that's sort of having an impact on travel. We've seen that.
So imagine that. So air traffic controls haven't been paid since October 1st, and many are not coming into work consistently because there's not really a huge incentive for them to come to work. When you think about the amount of hours that they're going to be working a grueling, very high stress job and not getting a paycheck, not even guaranteed when you'll get a paycheck. President Trump even kind of teased the idea of saying, oh, like they may not even get paid, but legally speaking, they have to get paid. So as far as legal grounds goes, they will get paid all their money back. But the question is, how they're dealing with their personal life, balancing their personal life and their working life. It's very difficult not knowing when your next paycheck's going to come in. So this is really concerning.
In the past couple of days, where we've seen airlines, the airports having to cut sort of capacity in sort of put in slowdowns and restrictions on traffic coming in and out of airports because of the air traffic controllers not being up to staffing levels that they need.
We've got a live look there for our viewers on Bloomberg TV and on YouTube of Reagan National Airport in Washington, D.C., which has been no stranger to ground stops recently. Is this the level of airport that we're talking about here when we consider 40 potential markets? And what does that mean for safety if people are preparing to get on a plane?
It is a concern for safety, but at the same time, the FAA is saying that they're taking these measures to ensure safety.
Understood.
And they're talking about how this will help them manage the traffic and keep traffic at manageable levels. And that's something that the government is sort of talking about as a measure that they're doing to maintain safety. And so you'd rather be safer with fewer flights than have too many aircraft in the air for controllers to control.
And this is to begin Friday, correct? We'll find locations
we will
tomorrow
find tomorrow
to be implemented Friday.
Yeah, exactly.
So this is going to happen tomorrow. It's crazy to think. I almost forgot to say it was Thursday. So tomorrow this is going to happen. And again, the centers are at impasse right now. There seems to be no agreement as far as when the shutdown is going to end. So who knows when, how much leverage is going to have to take, really. So, so flight disruptions and food aid or SNAP benefits, those are the two biggest things that are affecting Americans right now due to the government shutdown. And here's the thing, exactly what I said earlier. House Speaker Mike Johnson said today that there's less optimism. He's less optimistic about bipartisan negotiations in the Senate, where Democrats have demanded the Republicans address expiring healthcare subsidies in exchange for their votes to reopen the government. So there's not more encouragement, but the opposite effect that's going on right now in these negotiations. So yeah, this is very concerning because it looks like that Democrats are not willing to budge when it comes to the government subsidies for healthcare provisions in the bill, and Republicans don't seem like they want to change the terms at all. So this is going to be, seems to be the biggest standstill that's that's been going on right now. And to get more context, that 10% flight capacity is expected to cut across 40 major airports to relieve staffing pressures. So 40 airports across the country, this is what it's going to affect. So that's a pretty big deal when we talk about that here. So Senate Majority Leader John Thune is planning a 15th vote tomorrow to begin a debate on the House-passed stopgap. Republicans say this is just a first step toward amending the bill with a new version that includes the 3 full-year spending bills and a stopgap for the remaining agencies of government. Okay, so they're going to do another vote, looks like, but again, there's not much hope at all about what's going to happen, because if you just keep on voting for the same exact bill, nothing's going to change unless one of the parties cave to pressure. And it seems like for the first time in American history, we haven't seen anybody cave. So this is definitely really wild and something that is unprecedented. So again, if you enjoyed this segment, please like, share, subscribe to the channel, comment your thoughts below, and I'm going to keep you all posted on what's going to happen here. And yeah, thank you all so much for listening.